In our last video, we talked about Chapter 5 of The Intelligent Investor and built the lazy portfolio. It was safe, it was simple, it was kind of boring, but you know what? It works. It's designed to get you the market average reliably for the rest of your life. But I know some of you, I can hear you through the screen. You're not satisfied with average. You want to beat the market. You want to be an enterprising investor. And that's great. But before you jump in, Benjamin Graham has a crucial warning for you. If you want to play this game on hard mode, the first thing you have to learn is how to not die. That brings us to Chapter 6, which Graham calls Portfolio Policy for the Enterprising Investor, the Negative Approach. It's a brilliant idea. Before he even tells you what you should buy, he gives you a strict no-go list. These are the assets that Wall Street absolutely loves to sell you, but that the intelligent investor should refuse to touch. These are the financial landmines that can blow up your entire strategy. So let's get into the things you need to ban from your portfolio, starting with the most tempting one. Imagine a stranger walks up to you and asks to borrow $1,000. You have two options. Stranger A has a steady job, owns a house, and has a perfect credit score. He offers to pay you 5% interest. Then there's Stranger B. He's currently unemployed, has a bit of a gambling problem, and owes money to some shady characters. But he makes you a tempting offer. 15% interest. Who do you lend your money to? It seems obvious, right? You go with the safe bet. But here's the crazy part. Wall Street tries to sell you Stranger B every single day. They just give him a fancy name, a high-yield bond, or more accurately, a junk bond. Graham's advice on these is simple and direct. Stay away. Now you might be thinking, but I'm an enterprising investor. That 15% return sounds amazing, and that's exactly the trap. Graham warns that this high yield isn't a sign of opportunity. It's a giant red flag signaling immense risk. When the economy is great, everything might seem fine. But the moment a recession hits, Stranger B is the first one to lose his job and default on his loan. When that happens, the price of these junk bonds crashes. You don't just lose out on that juicy 15% interest you were promised, you risk losing your entire principal. Your $1,000 could vanish. Graham's rule is crystal clear. Do not get stuck in the muddy middle. If you want safety in your portfolio, you buy high-grade, top-quality bonds, like government treasuries or AA-rated corporate bonds. If you want profit and growth, you buy stocks. Junk bonds try to offer a little of both, but they end up giving you the worst of both worlds, the high risk of stocks without any of the long-term growth upside. It's a sucker's bet, designed to lure in the greedy and the uninformed. The intelligent investor knows better and walks away. Next on Graham's no-go list are foreign bonds. Now, hold on, I know what you're thinking. We live in a globalized world. Isn't diversification a good thing? Yes, but Graham's concern wasn't about geography. It was about information and stability. Back in his day, getting reliable financial data from other countries was incredibly difficult. Plus, there was a huge risk of currency fluctuations or political instability wiping out your investment. Think about it. You could buy a bond from a company in another country, and that company could be perfectly healthy. But if that country's currency suddenly loses half its value against the dollar, your investment gets cut in half through no fault of the company. You're adding layers of risk that are almost impossible for an individual investor to analyze properly. Today, things are a bit different. We have global funds and easier access to information. But Graham's core principle is as valid as ever. Don't invest in what you don't understand. If you can't confidently assess the political climate, currency risk, and local regulations of another country, you're not investing. You're gambling. For most enterprising investors, it's a game that isn't worth the risk. There are plenty of great opportunities right here at home that are much easier to research and understand. The third item on Graham's ban list is one that will probably surprise a lot of new investors. IPOs, or initial public offerings. These are a Wall Street favorite. The hype machine goes into overdrive, telling you to get in on the ground floor of the next big thing. They sell you a story of explosive growth and overnight riches. Graham calls this what it is, a sales tactic. Most IPOs are not offered to the public because the sellers want to do you a favor. They re-offered because the market is hot and they can get the highest possible price for their shares. You, the public investor, are often buying at the absolute peak of the hype. The data backs this up. Studies have shown that the vast majority of IPOs underperform the general market in the 1 to 5 years after they go public. For every one that becomes a massive success, there are dozens that fizzle out or crash completely. Sure, the insiders who got in early make a fortune, but the public who buys on day one, they're often left holding the bag. The enterprising investor isn't interested in hype. They're interested in value. They look for established companies with a long track record of profitability and a price that is reasonable or even cheap. IPOs, by definition, have no public track record and are almost always sold at a price that is anything but cheap. So your rule of thumb should be to let the hype die down. Wait a few years, let the company prove itself in the public market, and then, only then, analyze it like any other stock. So there you have it. Graham's 3 major no-go zones for the enterprising investor. No junk bonds, no unanalyzed foreign bonds, and no speculative IPOs. Wall Street loves nothing more than an IPO, an initial public offering. It's a huge party. You see the CEOs on TV, confetti is flying, bells are ringing, and everyone is celebrating. But Benjamin Graham? He hates them. He calls them new issues. So why the hate? It all comes down to one word: timing. Let me ask you a question. When would you sell your house? Would you sell it when the market is booming and buyers are practically throwing money at you? Or would you wait until the market crashes and nobody wants to buy? The answer is obvious, right? You sell when the market is hot to get the best price. Well, companies are no different. They choose to go public and offer an IPO precisely when the market is euphoric and investor excitement is at its peak. They are selling you shares at the exact moment they can get the highest possible price. This is why Graham gives us a clear rule. The intelligent investor does not buy new issues. Think about it. You're buying from a very smart seller, the company itself, who knows way more about their business than you do. At the very moment, the price is most likely inflated. For a modern example, just think back to the SPAC boom of 2021. Remember all those hot IPOs that everyone was piling into? And then remember what happened a year later. Many of them crashed, dropping 80% or more. That is exactly what Graham was warning us about over 70 years ago. The lesson here is simple. Wait. Let the company trade on the public market for a few years. Let all that initial hype and excitement die down. Then, and only then, should you start to analyze its real value. Next, Graham touches on foreign government bonds. Now, in today's globalized world, diversifying your investments internationally is generally a good idea. But Graham's warning is still incredibly relevant. And it's about currency risk. Imagine you buy a bond that pays you in a foreign currency. Everything seems fine, the bond is paying out as promised. But what if that country's currency suddenly collapses against your home currency, like the dollar? Poof, you've lost money even though the bond itself didn't default. For the enterprising investor, Graham's advice is to stick to what you can thoroughly analyze. Unless you happen to be an expert on the geopolitical and economic stability of a foreign nation, you're not really investing. You're just gambling on their currency. It's better to stick to your home court, where you understand the rules of the game and the economic landscape is much clearer. Finally, Graham gets to the heart of what being an enterprising investor really means. And it's probably not what you think. Most people hear enterprising or active and they picture a day trader. Someone glued to 6 different monitors, mainlining Red Bull, anxiously watching every little tick of the stock chart. Graham says absolutely not. To Graham, being enterprising means putting in the work. It means doing your homework. It means dedicating the time to actually read a company's 10K annual report. It means getting out your calculator and figuring out the tangible book value. It means checking the debt ratios and understanding the financial health of the business. If your idea of active investing is just scrolling through news headlines and buying whatever stock is trending on social media, Graham would say you're not being enterprising, you're being unintelligent. The whole point of this negative approach is to have the discipline to sit on your hands, sometimes for months at a time. It's about ignoring all the so-called opportunities that Wall Street is screaming about, and patiently waiting until you find that one true diamond in the rough. So let's turn this into an action plan. Let's do a toxic waste audit of your portfolio. This isn't about adding things. It's a game of subtraction. Get out a red marker. And let's go through your holdings looking for these specific red flags. First, recent IPOs. Do you own any stocks that went public in the last year or so? Be very, very careful with these. There's a high probability you paid a hype premium when you bought them. The excitement was high and the price was likely inflated. Second, junk bonds. Are you chasing high yields by investing in risky, low-quality bonds? That extra percentage point of yield might look tempting, but it often comes with a much higher risk of losing your entire principal. And third, a modern form of junk. Unprofitable tech stocks. Are you holding on to companies that lose money year after year? Just because the stock price has been volatile and exciting? If a company has no clear path to profitability, you are not investing. You are speculating. If you truly want to be an enterprising investor in the way Graham intended, you have to be willing to cut the fat from your portfolio. That means selling the speculation and keeping the cash ready for genuine, well-researched opportunities. It's about building a portfolio based on value, not hype. Thanks for watching. If you found this helpful, don't forget to like this video and subscribe for more lessons from the greatest investors in history. See you next time.